I am going to welcome, for our wrap-up session, John Ryan. John is the President and Chief Executive Officer of the Conference of State Bank Supervisors, a position that he's held since August of 2011. John first joined the CSBS in 1997 as an Assistant Vice President for Legislative Affairs, and early on in his career, he spent 4 years as a staff member to the U.S. House of Representatives Committee on Banking, Finance, and Urban Affairs. John holds a bachelor's degree in political science and economics from the University of California at Berkeley. John?
Thank you, Julie. So I have a few things that I'd prepared to talk to you about. Before I get into that, though, I'd like to give you all just a little bit of hope in terms of how regulators are approaching and thinking about technology. So something that many of you may not know about CSBS, but we're effectively a core service provider, C3 nonprofit, but a cooperative service provider for the 50 states as non-bank regulators in running and operating the nationwide mortgage licensing system, which has turned into a system of multi-state supervision. And through this process, we have certainly gained a great appreciation for the value of technology, the information that we can use and bring together, and how the lowering cost of technology is enabling us to do things in a coordinated way as a system of non-bank supervision that we never could have conceived before. We're also going through a process of development right now that is based on Agile. We moved away from a waterfall approach to development to an Agile approach that has been incredibly beneficial. We have some bruises and scars throughout this process and learning that we're doing, but I think understanding and bankers understanding that regulators are not just regulators of technology or technology use, but also becoming developers and consumers themselves. So I think we're in similar places, one, in seeing the value of a lower cost of supervision, the lower cost of technology, and some of the solutions that it can provide. So I'm hopeful on that front as a group of regulators how we might be able to approach innovation within the banking system and around this banking system that will be to the benefit of our core financial system. So I'm pleased to provide a few closing remarks here today after a day and a half of discussion in a really unique format about community banking and the current state of community banking and the future of community banking. But something that I think is really important to discuss, given what happened this week 10 years ago in the context of the financial crisis, and that was really the context in which we established this conference 6 years ago. It was a little while in the making. But 10 years ago today, not today, yesterday, but this week, TARP passed. But also 10 years ago this week, TARP failed. And what we have had in the 10 years since is a raging debate, and it continues today, about the appropriateness of a federal guarantee, that safety net, how far it could extend or not. It continues as we're talking about fintech and bringing new players into the financial system, the appropriateness of that safety net, and the context of 10 years ago that there were decisions made for that safety net to be applied in different ways and unequal ways within the insured banking system. So some banks received 100% protection, others did not, were allowed to fail, and that created the context really for this conference. Because there was a lot of justification, we really need to preserve this core of systemic institutions. Today, I think we had a question about whether or not community banks are systemic, and it was interpreted, you don't want to be systemic because that comes with lots of different burdens. But 10 years ago, being systemic meant life or death. And we're still debating those decisions and what's the value of the diversity of this financial system. There were a lot of assumptions and 2 decades worth of policy work in Washington that supported a much more consolidated system. And you still hear the outgrowth of that debate and what Trace mentioned about concentrations. So concentrations were a bad thing. Diversification, geographic diversification, global diversification, product diversification were all considered positives. I think we've come to a more nuanced view of that in the intervening years since the financial crisis. But this notion that a more consolidated system and a safety net that backed the pillars of that consolidated system were in the best interest of our economy is something we're still debating. And the question about, do we really need, at the time, 8,000 banks or 7,000 or 8,000 banks, do we really need that? The Canadian model works pretty well with 4 fairly dominant banks. So do we need all these institutions? Are community banks really just a residual policy decision from the 19th century where distance was much more difficult and distance matters less, and that banking is really a matter of scale. Large folks do just what smaller folks do. Those were a lot of the assumptions and part of the debate 10 years ago this week when TARP was being discussed and decisions coming out of TARP and leading into TARP in terms of what was backed or not. We had decisions around conservatorship of Fannie and Freddie. The Congress had said that the full faith and credit was not behind the bonds that the agencies issued. But in fear of a collapse of global confidence and what it would do to our housing finance system, the federal government stepped in and overrode that decision, that explicit decision from Congress. However, they made another choice around preferred stock. There was an evaluation. It wouldn't impact our largest systemic institutions. It might impact others. There we can allow market discipline. So we continue to have this debate about the safety net, its the appropriateness of its boundaries, what its purpose is, and they're unresolved, and I think they're going to continue to be challenged. I would say one of the most significant contributions of this conference to that debate is providing better quantitative analysis around what diversification actually means, its value, but also some of its shortcomings, where we saw in past conferences that actually fairly focused banking models still performed well throughout the financial crisis, that we had niche institutions or focused institutions that did very, very well during the financial crisis. Another significant contribution is the role, and probably the most significant contribution, is the role that community banks and the diversity of our financial system play in our small business lending ecosystem. We see that proximity does matter, that through the downturn, larger banks contracted more and were slower or didn't return to small business lending in the same way that smaller institutions did. So maybe that's a home credit bias, but we care a little bit more about we care less about home credit bias if we're talking about 5,000 or 8,000 institutions than if we're talking about 5 institutions. So this contribution has been really significant in understanding, and it wasn't understood at the time TARP and other things were being debated 10 years ago, that smaller banks did half of small business lending. There was just an assumption that it didn't matter, that it really was a matter of scale. It didn't matter whether we had this diversity of institutions or not. So I think that's a really significant aspect of the year-over-year discussions that continue to evolve about the role of local institutions. We have had this discussion many times in terms of physical proximity to the borrower, and we see this year that seems to matter not just for small institutions, but for large institutions, that a physical branch location, loan officers are meaningful in large institutions as well as small institutions in their small business lending. So we probably aren't at the point, it seems like we're not at the point, and based on last panel's discussion, where we can replace with technology all the services that a diversity of branches and banks across this country provide. I think that's important for us to understand as we're debating fintech and policy and where we're going. So a few other things that I think that we've learned this week, that for community banks, that relationship lending is more important than standardized loan products. You all community bankers know that, but reminding ourselves of that I think it will be interesting to explore this concept that a remote lender is providing more loans in areas with less access as it relates to SBA loans. How much of that comfort with that distance in the lending decision is reliant on that government guarantee? But I think this is going to start to challenge some of the relationship lending assumptions as we look at fintechs or technology-based lenders and their experience, their lending experience. We certainly have had some important contributions. We see them this week from this conference in the time series of surveys that we've been doing, the community bank surveys that have allowed us to look at compliance. I don't think it tells us exactly where we are in compliance or compliance costs, but it helps push us in a direction and start asking more questions to understand this. It's certainly encouraging, but we know and continue to hear some of the frustrations. We heard from Trey Moust exiting a business line to be able to reduce compliance risk, not just cost, but risk. So there's still issues around compliance that we need to understand and focus on. Going forward, we hear that we have both challenges and opportunities with a focus on technology. The community banks, again with the survey and the discussants, are embracing technology, but that it's challenging to incorporate into a structure of core processors that, as was mentioned, were the original fintechs, that they enabled community banks to provide services that put them on par with our largest institutions. So historically an enabler, maybe a constraining factor, or sounds like a constraining factor now. So some challenges there in terms of the structure in the industry and how community banks can really adopt technology in the most effective and efficient ways and in a lower cost manner. I think that going forward, we're going to start to see as we talk about the loss in the last decade of 1,100 banks down to 5,000 and probably below 5,000 banks. What's the difference between 8,000 banks and 7,000 banks and 5,000 banks and 4,000 banks? It may not look the same, the difference between 5,000 banks and 4,000 banks, since we've seen a lot of consolidation of branch networks or holding companies. The future consolidation may have a more significant impact than past consolidation. I think that's going to be an important area of inquiry. I think we all appreciate, based on the lack of new charters, that the institutions we're losing are not easy to replace. And as we look at rural America, that they may not be replaceable. So I think that has us being very careful in our thoughts on application of supervision and really tailoring supervision, as you heard earlier, and the need for that if we're going to sustain or retain essential financial services in rural America. So this focus that we heard today on access to rural banking, some very encouraging, as successful as rural banks seem to be, some of it challenging, but it clearly needs to be a focus because we're not seeing new bank entrance necessarily into those markets, but we're seeing a retention of services. Finally, I'd be remiss if I didn't thank all of you, who are first-time participants at this meeting. Those of you, the few of us who have been at this meeting every year for the last 6 years. All of you banker, regulator, and academic participants who submitted papers and participated in the panels. You've made really important contributions to this ongoing dialogue that we're understanding. A decade ago, we thought we knew it was important. We're understanding more and more how important the diversity of this financial system is to our financial ecosystem and, frankly, to our democratic society. The trust in institutions, the ability to have access to services is at the core of our democracy. Specifically, I'd really like to thank Julie and the St. Louis Fed for hosting the Federal Reserve System, for being such a tremendous partner over the last 6 years, and we look forward to 6 or many more years, and to the FDIC for they have been a longtime partner, but their official sponsorship of the conference. With that, I think we can wrap up. But hope to see you all next year, and you continue to bring this debate home with you and ask more questions, challenge us, challenge our assumptions, so we can make a financial service system that best serves the public. We heard that challenge yesterday, really living into the original goals of our financial service system, which were debated in the 19th century. It was about local economic development, the connection at the local level, and I think that's going to be critical to its future. So thank you.